Welcome back to Yahoo Finance Live, everyone. Fed officials maintaining a hawkish tone this week. You've got Mary Daly, Loretta Mester, and Charles Evans, each signaling additional rate hikes should be expected. And this morning, St. Louis Fed President James Bullard weighed in. He told CNBC he expects another 1.5 percentage points worth of rate rises this year. So, is a soft landing even possible at this point? Let's bring in our next guest, University of Chicago Booth School of Business Professor of Economics and former Federal Reserve Governor Randy Kroszner. Such a great pleasure to have you here with us this morning. We'd love to get your expectations as we're getting a ton of Fed speak, both on the increase that could be probable, that is most likely, I should say, at the next meeting, and what you would be listening for as we do get some more of the Fed speak that comes out this week.
Well, thank you very much for having me on. Delighted to be with you. On the second question, I think it's very clear that the markets heard something different than what I heard at the press conference and from the Fed when they made their decision. They seem to hear that, oh, sure, we're going to be raising rates, but we'll bring them down fairly quickly next year. I don't think that's the case, and I think that's why the Fed speakers are out underscoring that we're going to be raising rates, and I think people have different views on how quickly they're going to raise them, whether they're going to end the year around 350 or closer to 4%. But nonetheless, they're not going to turn down anytime soon. They're going to keep them raised because they need to make sure inflation comes down consistently, and then inflation expectations stay down. Because that was one of the things that the Fed got wrong back in the late 1970s. Inflation came up. They started to raise rates. Inflation came down a little bit. They brought rates down. Inflation really took off, and they had to raise rates to double-digit levels.
Randy, the investors read that conference by Jerome Powell as a potential pause in rates coming later this year, and maybe even talk of a rate cut early next year. So just listening to you, you think that's misguided, at least from a market standpoint?
I think I agree. I think that's misguided. And I think the speakers who've come out have given a very consistent view that ain't going to happen, or at least that's not what they expect to happen. Now, of course, the economy could completely tank. And if we had to get a severe recession, then that's going to bring down demand. That's going to bring down inflation pressures, and they could begin to cut. But I don't think anyone has that as their baseline forecast.
Now, as we mentioned, you, of course, were on the Federal Reserve Board. What can you tell us about the sort of flavor of discussions at a time like this, right? Where obviously I think there's broad recognition that Fed officials do not have an easy job of it if they're trying to engineer a soft landing. What is it like inside the room where this is all going on?
Well, I think there seems to be pretty strong consensus among everyone, whether they're more hawkish or more dovish, that the Fed needs to fight inflation, and that's their primary objective right now. Obviously, they have a dual objective, but inflation is so far away from its 2% goal, and the unemployment rate is still quite low. This gives them an opportunity to continue to raise rates while they're close on one of the objectives, which is the unemployment rate, and they're very far from the other objective. But how quickly, how much, where they should stop, and my guess is there's a lot of back and forth about that. People will be making proposals on whether they should go faster, they should go slower, looking at different pieces of data, looking at, and in particular, I think they'll be looking at the labor market. Some people will say that's going to continue to be strong. Other people saying, gosh, we're starting to see some elements of weakening. And because we're going to continue to raise rates, the labor market will weaken considerably, which is my view.
And so, Randy, with the Fed being far away from its 2% inflation goal, as you were mentioning a moment ago, plus unemployment still being quite low, how would you describe the landing that should be anticipated?
That is the $9 trillion question. That's the size of their balance sheet. We haven't really been in exactly this kind of situation before, where you've got such strong underlying economic growth and a persistently strong labor market, and these supply shocks that are facing us, plus war. So what they're hoping is that they can raise rates, let's say, into the 3.5% to 4% area by the end of the year or early next year. Hold them perhaps in the low, around 4% or low fours for, let's say, 6 months or so. During that time, the unemployment rate is going to be coming up, but not going up too high. I mean, we're starting at a very low level at less than 4%. They're hoping that they can perhaps, well, they report that they don't think that inflation is, that unemployment rate is going to go much above 4%. I don't think that works because you can't raise rates so much, have so many negative shocks coming on the economy, and only get the unemployment rate to just slightly go above their long-term average. I think it's going to go higher than that. But let's say it just gets into the fives. That's a significant increase in the unemployment rate, but still pretty good by historical standards. That would certainly be a soft landing. The thing that we worry about is that the unemployment rate may go to 6% or higher, because there'll be continuing negative shocks from the war, from sanctions, and obviously geopolitical tensions in Asia. And so, unfortunately, I think that the shocks are more likely to be negative. And so we're in kind of a fragile situation as the Fed raises rates, and that could push us away from a soft to a softish, or even landing and even into recession.
Okay, and so you've kind of laid out what the soft or softish landing would look like. So again, just to kind of re-ask the same question, excuse me, because if I've got to describe this to my mother when I go back home, she's going to want to know what she should have in her mind as she's evaluating the economy. What type of landing, what type of picture should I be painting?
So I think she should be prepared for a recession. Because I think we do have an elevated probability of recession. I don't think that's baked into the cake. It's not necessary, but I think it's very likely from a combination of higher interest rates and negative shocks that'll come in from war, sanctions, geopolitical tensions, et cetera. So I think if you're thinking of building your portfolio, make a defensive one against the possibility of a recession. But I do think the Fed is going to be able to bring inflation down considerably. I don't think they're going to get to their 2% goal by the first half of next year, but inflation will come down. But a defensive portfolio, because the chance of things not going so smoothly are reasonably high.
Is it, just staying on the recession, Randy, is it a devastating recession, as Elizabeth Warren has been floating out there recently?
So I'd say most indicators and most economists would suggest that we're not there, that given how low the unemployment rate is, given that inflation expectations have not taken off. Remember, the last time that we had inflation this high, 40 years ago, interest rates were in double-digit levels. People don't believe me that can happen, but it can. If you got a mortgage at 12%, that was a great mortgage. And so we're far from that. So I don't think that the Fed's going to have to go to that level. And so I don't think we're going to have a devastating, early 1980s type recession. But of course, there are a lot of shocks that could come in that really have nothing to do with the Fed that could make things worse. But I don't see that that is my baseline scenario.
Two of the things that have nothing to do with the Fed, they have no control over energy prices. They have no control over the supply chain right now. And so what particularly in both of those scenarios would you be looking for to take place in order to kind of alleviate some of the concerns that consumers may have, even if they should be bracing for a recession, as you were mentioning?
And so on the energy side of things, I think we're not going to see a lot of investment to unlock hydrocarbon resources in the short run. There are too many uncertainties about that. And the Biden administration is kind of of two minds on this. They want more production in the short run, but they also say we want to go green and are going to potentially be taxing or taking away support for traditional energy sources going forward. These are long-term investments. You're not going to see an investment coming in there. We just had an OPEC Plus meeting where we've gotten very little increase in supply. So I think if you're looking at energy, the main hope, unfortunately, is that demand will fall off as the economy slows down. I don't think we're going to see an enormous, again, unless there's more geopolitical tensions, sanctions, et cetera. I don't see an enormous spike in energy prices from where we are, but I don't see them going down to where we were last year. I think they're going to remain elevated.
Great analysis for us here this morning. Randy Kroszner, our University of Chicago Booth School of Business professor of economics and former Federal Reserve board member. Good to see you.